Good day and welcome to another trading video with Monaco Daniel. In today's video, we'll be looking at supply and demand trading, some of the basic concepts of supply and demand trading, how to identify supply and demand zones, as well as how to mark out supply and demand zones. In subsequent videos, we are going to be going into more detailed and advanced concepts of supply and demand. But for this video, we are basically just looking at the introduction to supply and demand, as well as how to identify the supply and demand zones and how to mark out your supply and demand zones. Yeah, that's it. Now, before we dive right into what supply and demand trading is all about, it's very important that we understand the concept of supply and demand. Yeah, supply and demand is an economic concept. We need to first understand what this economic concept is all about before we relate it to trading any financial market. So, with that being said, supply are market situations where you have more willing buyers than sellers in the market, not more actual sellers, but more willing sellers than buyers at a given period of time. While demand market is a market situation where you have more willing buyers than sellers in the market at any given period of time. Yeah, so in situations where we get these stacks of buyers over sellers, we are most likely to find prices going up. It's simple logic. You go to the market and then you find more people selling a particular product than those who are actually buying the product. You ordinarily want to opt for the most affordable seller. While the same way in situations where you have more people wanting to buy a particular item than those who are willing to sell this item, sellers are likely to just order this product, and then this is going to force the prices of this product to go up. So the same is applied to trading any liquid market, be it the crypto market, forex market, or trading commodities like gold and grains and all the rest. It's still the same concept. So what we aim to do as supply and demand traders is to identify these price levels in our charts where we are likely to find more willing buyers than sellers, as well as those levels in our price chart where we are likely to find more sellers than buyers. Remember that for any liquid market, for any financial trading market, prices moved towards a particular direction as a result of buying and selling activities in that market. So if buying and selling activities, buyers and sellers, actually move price, then it will only be logical to assume that in areas where you have more money tied in, we are most likely to get a better reaction from the market. In areas where buyers find a lot of value, prices are most likely going to drop to such areas, and then we begin to see prices react to the upside. Meanwhile, in levels where we have more willing sellers than buyers, we are most likely to see prices rally up there, react, and then move to the downside. Yeah, it's as simple as that. We know that as retail traders, we trade very small portfolios. You can't compare the effect that a $1,000 trading account is going to make to the market and the effect that a 1 million or $1 billion trading account we have in the market. When someone with a $100, $200, $300 or even $1,000 account is getting into a buy position, for example, that's more like just a pinch compared to when someone with $5 million is stepping into the market. The size of the liquidity varies here. So someone coming in with $5 million could likely push prices towards a particular direction. Is the intensity of what is coming with. Meanwhile, someone that is coming into the market with $1,000, yeah, it's that person might move the market, but it needs more like a cumulative effort. It's not something that only one person with a $1,000 can do. Maybe when you put together several smaller retail trades, then in a particular direction, then it can move price, but ordinarily it doesn't. So as supply and demand traders, we want to look out for these levels in the charts where the big guys with the big money are placing their trades. We are not institutions. We don't have the resource to trade like institutions, but if we can't move the market, then we should at least try and trade like those that move the market. So the aim is to identify these areas, these levels in the chart where we have a lot of money tied to, and then look out for buying or selling opportunities along this level. With that being said, let's try to know what setups we trade as supply and demand traders, as well as how to look out for those setups. Okay, I'll move my charts a little bit. There are 4 setups that we trade as supply and demand traders. It is divided 2 for demand, 2 for supply. Okay, I'm assuming this to be my candles. I would use just a single color for everything. I don't want to change the color of my rectangle. So the 4 setups that we look out for supply and demand traders are drop base drop, rally base drop, rally base rally, and drop base rally. Now, I didn't bother changing the color of my rectangles, but one thing you should know is this represents candlestick. The drop is a bearish candlestick, while you could have your base candle to be any candle. Could be a bullish candle, could be a bearish candle, could be multiple candles, and then this is yet another drop. It's an impulsive leg, a strong sell. Yeah. Why the same thing with rally base drop. Rally is a strong buy, is usually a bullish candle. You could once again have your base candle to be bullish, bearish, or multiple candles. And then here we have a drop, which is usually the strong sell-off. It's a bearish candle. The same thing, rally base rally, rally to be bullish candle, be your base candle, another bullish candle, and then drop base rally, your bearish candle, base candle or candles, as well as your rally. Now, as supply and demand traders, when we see any of these setups play out in the market, what we would ordinarily want to look out for is the base candle. So I'm just going to clear this off, as well as show us how to identify these things in our chart. But before I do so, like I said earlier, both your drop base drop and rally base drop are supply setups. Yeah, these setups are used to identify areas where we have more selling pressure, where sellers see value, where we have the presence of a lot of sellers compared to buyers. Why both rally base rally and drop base rally are demand setups. These setups identify areas where we are likely to find more buying pressures than selling pressures, as well as the presence of more buyers than sellers. So I'll quickly get this off my charts, then I'll see how we can identify this from the chart. Now, another question you would want to ask is, how do I mark out my supply and demand zone? Now, supply and demand zones are called different things. A lot of people call it order block. To me, it is not any different from other blocks that you find this SMC guys marking. Yeah. So marking out your demand zone is usually done differently. Marking out your supply and demand zone is usually done differently by different supply and demand traders. You find a couple of these supply and demand traders who mark their zones. This look here, we have a drop, base to be multiple candles, and then a drop, a strong impulsive leg, another strong impulsive leg, and then this sideways movement is what is referred to as the base candle or as the base setup. So this is where you want to mark out as your supply zone, the base, where you have this large sideways movement. The thing uh with these big money traders is, yeah, they have the money to move the market towards a particular direction, which is an advantage they have against retail traders like myself. But the thing is, since the size of their order is very big, they want to place their order in a way that is going to be unnoticed. And the only way to do that is not just to go all in a single position or in a single price level. So what they do is they place these orders in bits, like in smaller size. So usually in these zones, in this area of supply or demand, you're going to find this sideways movement because institutions are not just placing all of their order at once. They'll put in just a bit of it and then wait for another opportunity to go in small again. So you find this sideways movement such as this in areas where institution sees value. Now, what we want to do now as retail traders, as supply and demand traders that are looking to trade with institutions, is to mark out this area of consolidation, this sideways movement, and then watch how prices react to it the next time it comes here. It's as simple as that. Call it order blocks, supply or demand zones, or whatever it is you want to call yourself. It's just looking out for this order, this high value range, and then looking out for market reactions when prices come back here to inform your trade. Now this is a supply zone, which as you can see is drop, base, drop. And another thing to also look out for when marking your supply and demand zone is the impulsive leg after the base candle. Usually when you have this buy stacks of buy orders or stacks of sell orders here, after these big money traders must have been done getting their orders filled, you see prices move quickly in a particular direction. So for a moment it is slow because these guys need time to get their orders filled, and then once their order is filled, market starts moving with a lot of pressure, which is what we have here. So marking out your supply or demand zone, like I said, is done differently by different kind of traders. Now some supply and demand traders, let me use this instead, would prefer to mark their zones or the candles from week to week, from this week down here to the week up here. Then they'll wait for prices to rally back into this range and then see the reaction. Look at how prices react the next time they come back here. While some other supply and demand traders are just going to mark from week, from body to week. Let's say something like this would be body to week. That's from body here to week up here. While the last way you can mark out your zone is just the body of your base candle. Yeah, you can mark out your zones just body like this. For me, I don't have a particular way of marking out my supply or demand zones, mostly because I do it differently on different time frame. how I mark out my zones when I want to take entries is a bit different from how I mark out my overall zones. So whichever way that is fine by you is okay. Now, this is a supply zone we have up here. What did you find with the next time markets came right into it? We saw this quick turning, this quick rejection from this place. Now, the thing is that, remember we said supply a supply market is this market where you have more willing sellers than buyers. So what happens if a lot of people are selling and then few people are buying? Yeah, the fact that we have more sellers than buyers doesn't necessarily mean we have um we are going to get more sell orders filled than buy orders. For when people are selling, you definitely need to have people buying the sell position. So what happens is that for retail traders who probably could not get in at this point, the next time prices are going to be coming up here, this new set of sellers would be waiting to sell here. Maybe people that even bought this sell positions here and feel like market is just going to go down and they want to break even or are looking to take just a little profit. Now they'll be waiting for prices to come back into this level for them to sell and break even at least. So their own selling pressure is now going to force prices down. That is it for one supply. I'll try as much as I can to look for another supply zone, so we just try this as well as some other demand zones. Okay, I think down here we have a demand zone. We have a demand zone down here, which is a rally. You can see the base candle. It's a bullish candle, just a very small sideways candle, and then another rally. Now look at what happens the next time prices come here. We came right into it, peak demand, get buy orders filled, and then rally up into supply. I'll look out for another supply zone up here. We also have a supply zone up here, and then you can see prices came right into it once, twice, three times, and then went down. This is the chart for gold. Yeah. Now let's see how supply and demand can be applicable here. Up here you can see we have a drop base drop, which is a supply zone, and then what happens the next time prices rallied up into it? We saw this huge sell-off, this strong selling pressure from up here, and then we are back into this supply zone. We are beginning to see market react off this supply zone. This is a daily supply zone. The same thing here, we have a drop base drop, and then prices coming right into it, dropping down into a demand zone. Here we have a rally based rally. You see prices dropping into it once, bounce up the second time, bounce up once again, and then here before we got that move up to this supply zone. Okay. Here we have a demand, a drop. You see two base candles and then rally. We have a drop base rally here for gold, and then look at what happens when prices came down here. We saw buyers quickly stacking up, and then prices almost immediately reacted off this zone. Let me look for another supply zone. Okay. Here we have a rally based drop for supply, and then prices came into it, and almost immediately we got the reaction. Yeah. So you could mark out your supply or demand zone whichever way you want to, depending on how you find it comfortable, how it suits your style of trading. One thing I usually say is, as a trader, you want to fit your trading around your lifestyle and not your lifestyle around your trading. Now, before I call it a day, one other thing I also would want to point out is that for supply and demand zones, the more a supply and demand zone is tested and respected, the weaker it becomes. I know for support and resistance trading, reverse is almost the case, where you find support and resistance traders saying the more a support or resistance zone is tested and respected, the stronger it becomes. Now, reverse is the case with supply and demand trading. The more a supply and demand zone is tested and respected, the weaker it becomes. This is because for every supply or demand zone, what we have there is just stacks of buy or sell orders. We have this large buying position or these big selling positions, buyers and sellers stacked in the market. So if let's say at this particular price level we have 100 sell orders with just 10 buy orders, and then for the first time prices rallied off here, rallied off into this zone, we get 10 buy orders filled, prices got rejected. Now we are left with 90 buy orders up here. The next time prices is going to rally back up here, let's say we find something like this happening. Okay, if you find something like this happening, okay, price is coming back into the zone and then rejecting. Now let us assume that this time around we got 20 sell orders filled, so we are left with 70 sell orders because we got 10 filled here, we got 20 filled here, we are left with 70. And then prices once again rally back up into the supply zone. It got tested and then respected back down into this demand zone here before going back up. Now let's say this sell order up here took 60 sell orders. Now the next time we are going to be rallying back into the zone, we are going to be having just 10 active sell orders. Let's assume that no new sell orders are placed in this price levels. Now we are going to be having just 10 sell orders and most likely a 10 or 20 or 30 buy orders. So we are most likely going to see prices rally up here, maybe get rejected a little because the pressure of the sellers up here is already weakened, and then break through it. Yeah, so that's why we say as supply and demand traders that the more a supply or demand zone is tested and respected, the weaker it becomes, because what we have up here is just people looking to buy or sell. And as human beings, we get saturated from buying a particular commodity at a particular price level. You go to market today and then you, let's say you go grocery, you get a particular item for a particular amount, you buy repeatedly at that price level. When next you come, you'll be looking for opportunities to buy lower than what you bought yesterday. Yeah, the same thing is applicable when you bring this example. If you are going to apply this to trading, you buy Bitcoin, for example, within this range of 45 to $48,000, and then it comes back, sorry, you sell off at 45 to $48,000, and then prices rally back up to this range, you sell your next stack of Bitcoin, and then it comes back, you sell once again. Now the next time it's coming, it's likely that you must have lost interest in selling there. You feel like, oh well, for long term Bitcoin should be bullish, so I want to buy, I want to be selling at a much higher price, and then this time around you are looking to sell up here at 58 to 61k dollars. You are looking to sell at 58 to $61,000 per Bitcoin. Yeah, the same thing if you are buying at let's say prices drop down to $30,000 per Bitcoin, and then you got some buy orders field, it dropped once again, you got some more buy orders field. You get to a point where you'll be looking for opportunities to buy below $30,000. You might be looking at this point in time to buy at 28, at 24, at 20, but prices move based on people's buying and selling activities. And as rational beings, we only do things for a particular period of time, get exhausted, and then want to opt for something better. Typically, that's what's applicable with this. So, you can pop up your charts, try as much as you can to identify supply and demand zones. You can, if you find it a bit confusing, you can reach me up on Telegram, via my channel, or send a private message to me, and you can be sure I'm going to respond to that. But try, it works on every time frame. Supply and demand trading method works on every time frame, and it is the same ideology that is behind supply, that is behind demand. It's just a reverse case of, in this situation you have more sellers, in this situation you have more willing buyers, but the same thing. You want to look out for these zones, look out for reactions, and then take out your trade. So you can try it on at least 3 time frames until you feel like, yeah, you're good with this, and then you move on. But this is definitely not the end to supply and demand trading method. This is just an introduction to supply and demand. I'll be making more detailed and in-depth videos, more advanced videos on supply and demand trading method. Like I said, I am a supply and demand trader, 100% of a supply and demand trader, and most of the videos that will be posted to this channel will be based off on supply and demand. In the next video, we are most likely going to be looking at something more advanced about supply and demand trading. Do enjoy the rest of your day, and once again, don't forget to like the video, subscribe to the YouTube channel, as well as leave a comment below. I personally attend to all comments. Thank you and have a great day.